Hello everyone, you're welcome to my channel Promotion for Sure. In this video, we are going to talk about international banking, the summary of Module A of Bank Financial Management, CAIIB. Now this video is going to be very comprehensive and it will cover the entire module in a summary format. And if you want to download the PDF copy, you can click the link below in the description and you can get a copy of it. It will be very good for quick revision. So let us quickly go ahead and start with our video today. Now, if you click to watch this video, be rest assured that you have reached a channel that will give you a treasure of knowledge, and that's a promise. So please subscribe and become a lifetime learner of a channel. Now, let's first talk about dealing room. Now, foreign exchange dealing room operations comprises functions of a service branch to meet the needs of other branches, divisions to buy or sell foreign currency. So, dealing room is a room which deals with buying and selling of foreign currency. It acts as a profit center for the bank and financial institution. A dealer has to maintain two positions, fund position and currency position. Now, the fund position reflects the inflow and outflow of funds, that is, receivables and payables. A mismatch in fund position will throw open interest rate risk in the form of overdraft interest in the nostro account, loss of interest income on credit balances, etc. Now, currency position deals with the overbought and oversold positions arrived after taking various merchant or interbank transactions, and the dealer is concerned with the overall net position. Now, the overall net position exposes the dealer to exchange risk from the market movements. The dealer has to operate within the permitted limits prescribed for the exchange position by the management. Back office takes care of the processing deals, accounts, reconciliation. It plays a supportive as well as checking role. Now, mid office deals with the risk management and parameterization of risk for forex operations. It gives market information to the dealers. So, back office deals with the processing of deals, and mid office deals with the risk management aspect of the foreign exchange. Now, let's talk about the risk in foreign exchange dealing. Now, RBI and FEDI issue guidelines to all banks to identify, measure, and manage risk. Risk can be classified under market risk, which is loss arising out of change in the market price of an asset. Liquidity risk, risks that you will see that will not be able to easily sell your assets. Now, operational risk is the failure of internal processes, people, systems, or external events. Legal risk is contracts are not legally enforceable or documented incorrectly. Credit risk is counterparty defaulting in payment. Now, credit risk is of two types: pre-settlement risk, credit risk before the maturity of the transaction, and settlement risk is timing differences in cash flows. Example, Herstatt Bank in Germany failing in 1974. Now, what is country risk? Movement of funds across borders may be obstructed by sudden government controls. Interest rate risk or gap risk arises out of adverse movement of interest rate a bank faces on its currency swaps, forward contracts, or other interest rate derivatives. Now, if we talk about management of risk, traditional measures adopted by bank management to manage limit risk are limit on intraday open position in each currency, limits on overnight open position on each currency, limits on aggregate open position for all currencies, a turnover limit on daily transaction volume for all currencies, country wise exposure limits. Now, if you have to talk about the guidelines on risk management, it measures the risk that can be quantified with exchange risk, interest rate risk using mathematical or statistical tool. They have a detailed policy on risk management given by the board, specific limit structure for various risk in operations, a sound management information system, specified control monitoring and reporting system. Now, RBI guidelines on risk management. RBI has issued internal control guidelines for foreign exchange business. It covers various aspects of dealing room operations, code of conduct for dealers and brokers, and other aspects of risk control guidelines. It specifies limits including gap limits, counterparty limit, dealer limit, deal size limit, etc. Now, if you talk about derivative instruments, derivatives are management tools derived from underlying exposure such as currency, commodities, shares, etc. It is used to neutralize the exposure on the underlying contracts. Can be over the counter, that is customized product, or exchange traded, which are standardized in terms of quantity, quality, start and ending dates. Now, forward contracts typically over the counter derivatives which involves fixing of rates in advance for delivery in future. Risk of adverse price movements is covered. Now, forward contracts are specified at forward rates, which are spot rate plus cost of carry. Now, if we talk about the forward rate is equal to spot rate plus premium or discount. Premium or discount is the function of cost of carry, which is the interest rate differential. The currency with lower interest rate would be at premium in the future. Other factors affecting forward rate are demand and supply for forward currency, perception about the movement in the currency, political, physical, and trade related conditions in the country and for the currency. Now, if you talk about the examples of forward differential, if uh, this is a very simple example, you can go through it, you can pause the video. Now, future is a version of exchange traded forward contracts, standardized contracts as far as quantity amounts and delivery dates of the contract is concerned. It conveys an agreement to buy a specific amount of commodity or financial instruments at a particular price on a stipulated future date. An obligation on the buyer to purchase the underlying instrument and the seller to sell it. Now, future types of future contracts: commodities futures, financial futures, currency futures, index futures. Now, there is a margin process. Initial margin to be paid at the start of the contract, variable margin which is calculated daily by marking to the market the contract at end of the each day, maintenance margin similar to minimum balance for undertaking trades in the exchange and has to be maintained by the buyer or seller in the margin account. Now, options: an agreement between two parties in which one grants the other the right to buy or sell an asset under specified condition and assumes the obligation to sell or buy it. The party who has the right but not the obligation is the buyer of the option and pays a fee or premium to the writer or the seller of the option. The asset could be currency, bond, share, commodity, or future contract. Now, the option holder or a buyer would exercise the option in case the market price moves adversely and would let it lapse if it moves favorably. The option seller is under obligation to deliver the contracts if exercised at the agreed price. Strike price or exercise price, the price at which the option may be exercised and the underlying asset bought and sold. Now, in the money, when the strike price is below the spot price or vice versa, in case of put option, the option is in the money giving gain to the buyer. At the money, when strike price is equal to the spot price. Out of the money, the strike price is above the spot price or vice versa. Now, call option, the right without the obligation to buy an asset. Put option, the right without an obligation to sell an asset. American option, an option that can be exercised at any time until the expiry date. And European option, an option which can be exercised only on expiry. Bermudian option, an option which is accessible only during a predefined portion of its expiry, the last date on which the option may be exercised. Market participants often quote an expiration month without specifying an actual date. In such cases, it is understood that the expiration date is the Monday before the third Wednesday of the month. Now, swaps in foreign exchange market, swap refers to simultaneous sale and purchase of one currency for another, which is currency swap. Financial or derivative swap refers to the exchange of two streams of cash flow over a defined period of time between two counterparties. Now, derivatives in India. Sudani Committee was formed in 1992 to look into the issue and the development of foreign exchange market in India. Some recommendations were: corporates should be allowed to hedge upon declaration of underlying assets. Banks may be permitted to initiate overseas cross currency. So this is the recommendation. Banks should be allowed to borrow and lend in overseas market. More participants should be allowed in the foreign exchange market. Corporate must be allowed to cancel and rebook option contract. Banks may be permitted to use the hedging instruments for their own ALM. Banks to be allowed to fix interest rate on FCNR deposits subject to caps fixed by RBI. The use of financial derivatives started in India in the 90s and foreign exchange and stock market in 1992. RBI had permitted banks to offer cost currency options to the clients. In 1996, banks were allowed to offer their corporate clients interest rate swaps, currency swaps, interest rates option, and forward rate agreements. The derivatives market in India is still in an evolving stage. So I hope if you have reached the end of this video, be rest assured you have reached a channel that will give you a treasure of knowledge. That's a promise. So please subscribe and become a member of our family. And I'm sure this video would certainly help you. Thank you. Have a great day. Bye bye.